Hi, I'm Merryn Somerset Webb, Editor-in-Chief of Money Week magazine. Here with me today is Mark Dampier, the Head of Research at Hargreaves Lansdown, which is the UK's biggest online stockbroker and probably its most successful. Mark has just written this book, Effective Investing, which I suspect really does tell you everything you need to know about effective investing. So we're going to start by talking a little about that and then talk about the markets in general and move on to talk about some of Mark's favourite funds, because if anybody knows funds, it's Mark. Right. So you have decided to pass on your many years of investing wisdom to the general investor, which is generous of you, obviously. But if someone was going to be encouraged to read the book, or perhaps not make it through the entire book, what would be the 2 or 3 things that you would say are absolutely vital for an investor to bear in mind all the time? An individual investor, not an institutional investor, because they have possibly different priorities.
Well, actually, I think the most important thing to bear in mind if you're investing at all is just to be patient and actually not to read too much, believe it or not.
Except for this book and Money Week,
right? Money Week and obviously my book, that's all you really need to read. And actually, I do actually think people read or can read too much. The trouble is that from a beginner's point of view, and I did try and write it almost from a beginner's angle, and it was quite interesting because it makes you sit back and look when you're writing it and think, God, this is actually quite hard. Because investment's kind of simple, but it's not easy. And there is almost an information overload. Technology has been wonderful, but it's created so much confusion in the market that people just turn off 3,000 funds, and I'm not counting offshore funds or whatever, and they think, well, where the hell do I start with that? And as you know, at least 90% of them are useless in the first place. So I think many people are turned off to begin with. One of the things I do try and get people to do is you have got to read. I think we're a lazy society, basically, and we just want it. We just want it on a plate, and that's the problem. And you can't do that on investment. And the government, everything in the UK is pushing you towards doing your own thing. And you've just got to be able to pick up. You've got to eventually have to pick up and read something. If you don't, you're going to be poorer for it.
Yeah, and most people don't, do they? Most people stay slightly in denial. They've got the money, they open the account, and then they don't really want to take the action.
It stays in cash because actually I think they're partly confused and partly because they just don't want to. They don't want to read. And they've got to. I mean, if you've got a computer nowadays,
well, read and take the responsibility. I mean, investing is tough. True. You know, you move out of cash, everyone gets cash, you have the cash, you feel like it's safe. Of course, it's not, because there's opportunity cost and you're not getting interest, etc.
You can give other people the responsibility, but in my view, that's quite dangerous and fraught as well.
You mean moving to a wealth manager as opposed to a fund manager?
Yeah. Which is a bit of a funny term sometimes, as far as I'm concerned.
What, a losing wealth manager?
Losing wealth manager, yeah, because that's why I think you should try and do as much as possible yourself. And I think actually you can mix DIYing with advising. I think you can do the work, a lot of the work yourself, and then you could probably go to an advisor and get what I would call a sense check, I think. So you present what you think you should be doing to someone to an advisor. In fact, I've done it myself recently just to see and experiment, and I think it's really useful because then they can say, well, have you thought about this? I mean, most advisors really are professional planners now rather than investment people, but they might say, if you're old enough, you might think deferring a state pension, you might think this, you might think that, but you're then at least armed with the questions, because most people, even if you're going to an advisor for the first time, haven't got a clue what to ask
well, this is interesting. Most financial advisors are no longer really investment advisors. No. They offer you all sorts of advice on various things. Well, but when it comes to the investment, they tend to contract it out anyway,
That's
don't
perfectly
they?
True. Well, I don't think they were advisors in the first place. When I first started 32 years ago, because there was no compliance, anyone could call themselves a financial advisor, and the advisors that had come up were all from Allied Dunbar. So actually, all they sold was managed investment bonds because they paid 5 or 6% commission. So they didn't even sell unit trusts because unit trusts didn't have managed funds in those days, so they couldn't deal with that. And I would say that's stuck pretty much through. And so, but good financial planners now are very good at the planning side, but they're not really good necessarily at the investment, because that in itself is a whole field.
Yeah. But the planning side is very important. But
it is very.
But for these purposes, this is more important. So number 1, be patient. Number 2, read, except that you must have some knowledge.
Yes.
You have to learn something before you start. You have to know the basics.
But you also need to be in an investment frame of mind, or actually not be a spender.
What is an investment frame of mind?
I divide people up to spenders, spenders and savers, and there's lots more spenders than there are savers.
But aren't we both at different times of life?
Not with some of the people I know. They just like spending all the time. But I've always been a saver, but then I've kind of been a bit old-fashioned because my parents or my mother's still alive, I mean, I have a devil of a job getting her to keep central heating on, because she's of that sort of ilk of in the Second World War, where things were rationed and you fought for things.
Yeah, but this is a mistake, isn't it? There can be too much saving. I mean, we want your mother to be warm.
I do, yeah.
And we want her to have,
Exactly.
a nice convertible car at some point before the end, and we want her to have nice holidays.
So
So there are two
two.
problems here, aren't there?
Yeah,
Some people save too much, and some people won't save at all.
It's not, in my view, many people save too much, and they don't start early enough either.
Yeah. How early do we have to start?
As soon as you can, as soon as you've got any money. So basically,
Yeah, well, for young people today, that's 50, right?
Yeah, well, that's what they say. But I reckon most people can save something if they really want to. And nowadays, of course, in my day, you only had an endowment savings plan. There wasn't anything else. You've now got unit trust, investment trust savings plans, which are cheap and cheerful, which you can start for around about 25 quid a month. And I know people say, oh, I can't afford that. But actually, once it goes out of your account, you forget about it.
Yeah.
And it's amazing how much that totals over the years. So just start. For God's sake, just do something. Just don't sit there. Do something.
Okay, so save, start, then be patient. And when by patient, you mean remember that investing is a long-term game.
Yeah.
This is something that if you're going to put money into a stock market, you need to
Yeah,
know that you're there for 10 years.
I think you've got to think of 10 years plus. Unfortunately, I think someone told me that the average holding period for funds was more like four years now,
Right.
which is absolutely ridiculous. It's way
Yeah.
too short. Someone actually suggested that the industry should change because of that, but I actually think that's wrong.
The industry
Individual
should
has to
change the way
So
they
the
manage
industry
the
has
money.
yeah, that was what it was suggested to me by someone in the industry, and I said, well, that's completely ridiculous.
But because we know you can't successfully invest
you can't
regularly over a 4-year
No,
period,
it's
don't we? It
completely-
just doesn't work like
It
that.
doesn't work. So that's just a nonsense. It can't work like that.
Okay.
So you've got to look over 10 years plus, because you also know that you're going to have some pretty bad times, but you don't probably know when they're going to come around as well. And that's when you're real. I mean, in a way, you're battling yourself, because you're your own worst enemy usually. And reading and seeing the newspapers, and you look at 2008, and you think, my God, it's the end of the world. How many people sold out of investments, even regular savings plans, at a time when, if anything, you should have stuck tight. And actually, if you're doing savings plans,
Did
should
you
have
see
actually put
that
more
at
money
Hargreaves
in.
Lansdown? People stopping saving into their regular savings accounts
Saw a few
during the
people
crisis.
do that. Yeah, not hundreds, because actually the great thing with regular savings plans is people do tend to forget them.
Yeah.
It's actually when they get the damn statements, you see. So, and very early stage people get put off. They say, oh, I put £2,000 in over 3 years and it's worth £1,500. Oh, this is no good.
I'll take
and
it
back
out.
it down, take it out.
Okay, interesting. So do you think that one of the things perhaps that the government could do to help would be to stop with all this transparency and reporting nonsense and just not insist that brokers send out statements? Let people send the money in,
Well,
send them a statement every 5 years or even every 10 years.
That would be great,
to
but
stop
it wouldn't
them.
work. But it wouldn't work. It's a bit like quarterly reporting for companies, because I don't think. I think that's too. It's ridiculous, quarterly reporting.
Yeah, why should we care
And
what
in a
happens every
way,
quarter?
technology's made it worse. I mean, Hargreaves Lansdown, you can check your portfolio 24 hours a day on the other side of the world.
But who does that? What percentage of
quite a
Hargreaves
few
Lansdown
people
clients
do.
look every day?
Well, quite a few people will look every week.
Do they?
Yeah, they do.
Interesting. I can never remember
and-
my password.
So you don't look very much, but you're right. You shouldn't actually be looking very much, and because that's what makes you start making decisions.
Yeah, well, this is the other thing that I thought you were going to say, which is included, I suppose, in Be Patient, which is don't look, don't trade.
Yes, I think masterly inactivity, but that is in itself is incredibly hard to do, especially when you switch on the news. I mean, you think of 2008, of all the things, Bear Stearns, Northern Rock, we had Lehman's, all those problems, and the diet of ghastly comment coming from everyone, and you just think, I just can't stand this anymore. I think you should just turn the screen off and go and play golf or whatever takes your fancy, and just don't look. But that is the hard thing to do, and I don't think people I think people are just caught by their own emotion too much. I mean, Warren Buffett actually didn't sell anything. He was buying, if I remember, in 2008. I'm not saying he bought everything right, but he didn't sell. He didn't crystallise a loss. Why are you crystallising something you don't need? If you've got enough in cash, you don't need it. I'm kind of telling things that are very obvious, but people just don't
being
seem to
reminded
do it.
of the obvious is a very good thing. That's what we're trying to do here. So, okay, let's say we've started reading.
Yep.
What you say we must read, we must have basic knowledge. When you say that, you mean about valuation techniques? You mean about what's going on in the investment world in general? You mean about how funds work?
I think almost all those things are a help. Some history as well of where you are in stock market history and valuation, whatever your valuation metric might be. But just looking at the past performance of funds might help. If something's gone up 500% in 2 years, it might just suggest to you that something's really been overcooked. So for some very, very basic stuff like that would be really helpful to people, rather than just looking at past performance.
Yeah. And let's say that I'm a young person. Well, I am a young person, obviously. Let's say I'm a really young person, and I'm just starting to invest. I've got a small pot, and I'm going to set up a regular savings scheme from now on, and I'm going to indulge you by doing it to Hargreaves Lansdown. What should I be buying now? What am I looking at?
Well, in a way, you're buying for the next 20 years, hopefully.
Yeah. Well, let's say I'm buying for the next 10 years. I'm not that young. Let's say 10 years.
All right, 10 years, fine. Well, I don't think I've changed. If you'd asked me that 10 years ago, I don't think I'd change. I'd look at things like emerging markets, and I'd look at things like UK smaller companies.
Okay.
Because they're slightly more volatile, but I think you'll make the better gains over those years. And because you're investing monthly anyway, they'll iron out those fluctuations over time. And in fact, I can tell you what I did, because when my son was born in 1990, that's exactly what I did for him.
And you just left that there?
And I left it. And I've only just given him the money at 25. Actually, I wouldn't give him the money at 18. So I've broken probably all the rules. Or whatever.
Okay, what was the
Aberdeen
average
Emerging Markets Fund, and we put very little, because I have to remind people, in 1990 interest rates were at 15%. I could barely pay a mortgage, so I was putting about 20 quid a month away. I can't remember. I think I gave him. I think it was worth about 19,000 quid when I passed it over to him.
You got any idea what the return was?
I haven't actually worked out the return.
Period?
I'm sorry, I should have sort of sat down. But it's what I can tell you was the first 4 years were really good in emerging markets, and then it really fell like a stone from 94 to about 2000, which is just what you want for a savings plan. Really just plunged about 80%, and then of course over the last 10 years, been brilliant. Went up sort of 500-600% over that time. Emerging markets have been a great
You just told us
time.
not to buy funds that have gone up 500%.
Hey, but they hadn't when I accumulated them all at very low rates.
You just told us you would do the same again today.
Oh, no. Yeah, but emerging markets have had a really rough ride over the last 4 or 5 years. But I'm looking at, I'm looking at long term, and I think if you do monthly savings plans, you just pick a reasonable asset class, and that's what you should go for.
Would you still go for Aberdeen? Haven't done that well recently.
No, it's had a tougher time. I don't know where I'd be put off by not. Yeah, I'd probably still stick with Aberdeen. Yeah.
Okay, so here I am, young person, and I'm going into Aberdeen emerging markets. And what am I doing small cap wise?
Small cap wise, well, I could probably take someone like Marlborough without too many problems, or Standard Life. There's a lot of good smaller company funds out there, good fund managers out there that should be fine over that time period.
Who are your favourite fund managers to invest with for the long term?
Well, of course.
I mean, you know them all, right?
Yeah, I know, but of course, because over the long term, it depends when they're going to retire nowadays.
Okay, let's
I've grown up with some of them, but I mean,
let's choose ones who are under 60. Okay,
well,
okay, under 50.
Under 50, no, that's really tough, because most of the good fund managers are over 50, in my view.
Okay.
They've made all the. If I took a young fund manager out, I'd probably take someone like George Godber, who's at Myton, and he's not very well known. He's not actually on my list. He's only got about a 5-year track record at the moment, but I think he shows all the promise of.
And what's his
doing
fund?
Well. It's Myton UK Opportunities.
Okay.
But then
so that's mainly small medium cap.
It's kind of small mid cap, very much a value kind of play as well, which I kind of like, because value over the years.
You veer towards value rather than growth.
Well, percentage wise, if you want to play a percentage game, value tends to outscore growth over most time frames. So that seems to work well. So he's probably one that I would notice of that sort of younger age. The problem with active managers is they have careers and they retire and they move.
And they
whatever.
move. Yeah.
That's the real
Particularly
pain.
the young ones, they'll move, right?
They'll probably move in a couple of years or so. That's within the first few years. That's just a problem of active management. If you don't want that, then you just have to pick a passive and just go. But then even that's a decision.
Yeah.
Because
there's no such thing as passive, is there? Because there's always allocating it.
There's an active decision to what you buy. And look, if you just bought the FTSE 100 over the last 10, 15 years, you wouldn't have done particularly well. But if you'd done the 250, you would have done remarkably well. So huge differences. So people who think that passive is easy are wrong as well. Even that's quite a tough decision.
Well, let's go for the older fund managers. If we must take one of these over 50s, who's bound to retire any day.
No, I don't think Neil Woodford's about to retire. So I'd still.
Well, he's
I've
just
still
set
got-
up. It'd be embarrassing to
So
retire
he'd be
now.
a bit. I think he'd be one of those people that would probably.
He's going to
end
have
up
to go a
dying at his
decade.
desk
Well,
or
now
whatever.
he's done all this. He's got to go a decade,
Oh,
right?
he'll have
It
to
would
go
be
more than a decade because I think with Patience Capital, I think he's over. I think his ambition is to take a company from start-up to
Patient
FTSE.
Capital. Just to be clear to readers who
Yes.
don't know it, is his new investment trust.
Yeah, that's his investment trust, and so I think he has a real. I think that's a real ambition to take something all the way through. So I think he'd be around for 15 years or so at least. Actually, Patience Capital investment trust would be fine for younger people because they've got that sort of time frame in mind. I think, which is great. And people like Nigel Thomas, who's at AXA Framlington, but he's 60 years old now.
Oh,
So, mind you, I did see him the other day, and he's
Looks
got
all right.
He's all right. He's no plans to retire, and I go fishing with him from time to time.
but he wouldn't
He's
say
okay.
so, would he?
Oh, he would actually.
Really?
Yeah, Nigel. People at that age, and people like Neil have made so much money they don't need to work.
Well, that's what I was going to say. I mean, these aren't people who are going to care one way or another about the pensions regime or
no.
stuffing another 40
Not gonna
grand
worry
into
about
their
that.
pensions before April,
Exactly.
etc.
They'd be more
Not
like
on their list.
Niels Torb, who died at his desk at what, 82
Yeah,
or
yeah,
83
yeah.
or something. Well, I'm not sure they'll do exactly that, but while they're still enjoying it, it's an intellectual challenge. That's the way that a good fund manager will look at it. It's bit like being back at school. They like being top of the form if they can, and so why would they pack in? You go to ruin. It's only those who can't take the pressure and maybe just think it's too stressful. People like Ashton Bradbury, who I sadly left the industry a year or so ago, who I thought was one of the best fund managers I've ever met.
And he just had enough.
He worked really hard. He was very diligent, and he just said, "I've had enough." But I tried ever so much to get him back in because I thought he was probably one of the most underrated managers. But it would be in my top 3 of UK fund managers, and then he retires. So those are all the problems with active management.
Yeah. Are you seeing good new fund management companies starting up, new boutiques?
Well, there's one or two, but they're not new because boutiques are set up by older fund managers, aren't they?
Yeah, okay,
Yeah,
but
but
all
so
the
you've
fund
got-
managers setting up good
So
new
you've got
companies.
people like Sanderton, which is Tim Russell. Obviously, you've got Woodford, who set up, and Richard Pease, who set up sort of Crux as well. So there's still stuff coming. There's still plenty of things coming through.
Yeah, because it always seems that these small funds, when they're starting out, they run by good managers at newish
Yeah.
companies, tend to do rather well.
Yeah, I think they do. Well, they're normally smaller funds as well.
Yeah,
so-
exactly. Smaller
so that's
funds, slightly more
exactly-
nimble.
So yeah, but with experienced fund managers, it's actually quite a nice mix. In fact, it's probably my favourite mix. Experienced fund manager who then is in charge of his own destiny, not likely to leave because it's his company.
Yeah.
So that's kind of the best you could probably go for. And Richard Pease, when we last looked a year or so ago, not that you would have identified him from day one, but he's made 36 times your money over his period. So that's not bad.
That's not
So
bad at
if
all.
If you can kind of follow those sort of people, you don't do too badly, which is why we don't spend too much time on asset allocation. We'd like to try and, at Hargreaves Lansdown, we try and pick what we think are really good fund managers and pretty much stick and hold with them, rather than saying, well, is America slightly better than the UK or whatever, and try and do a lot of heavy asset allocation in that way, because we think you lose more money through that way than any other.
Through asset allocation, through trying to guess the
Trying
future.
to kind of guess the future really is what
Yeah.
most people end up doing, and it's just not worthwhile.
Yeah. Now it's almost a pointless question because the answer is so obvious. But you are a great believer in active management. Is there a role, do you think, for passive investment? I know we've just said that there's no such thing in an asset allocation
look,
where you're always taking decisions. But is there a role in a portfolio for using passive funds alongside active funds?
Yeah, there is, where you can't find a decent active manager. America's it's really hard to find good active managers in the States.
Really?
I'm sure
Why is that?
I have no idea, but I'm sure there are in the States, by the way. But we have real struggle, and if you ask other groups, they have the same struggle of finding someone who's. Where is the Neil Woodford in America? Where's the Nigel Thomas? We find that really hard. So a tracker might be a better route there. We don't. You can see on our list we have one fund at the moment, and that's done really poorly of late as well. It's really, really tough market. Maybe it's a very efficient market. Maybe that's where you should track. So I'm not against a passive in that way. And actually, from a beginner's point of view, that might be the place to start. And our view has always been, well, my view of the book is to just get people investing, and that means passive. I think the industry spends too much time bickering. So we have the passive and active, we have the investment trust and the unit trust debate. And if you're a beginner, you'd be looking at all this thinking, well, these experts, even they don't know what's best.
Yeah, and
so
a lot of this is kind of the
do?
same. A lot of active funds aren't there, different to the trackers.
Yeah, well, exactly.
Just
so
a tad more expensive.
So we all end up arguing, but then to the beginner, they just go, get it, I'm out.
And of course, the big upside to passives over actives is the cost.
Yeah, I can't possibly argue, and costs have really plummeted on passive, unlike active.
But that makes sense because these are commodity instruments, right? So they're all the same.
Yeah.
So it's just there's no way to argue about differentiation.
No.
So you can only differentiate on the price.
No.
And obviously with active, you can always pretend this one is different to that one is different to this one, which is often not the case. You look at the top 10 holdings of a lot of these big funds, and they're basically the same fund. They should be competing on price as well, but of course they're
that's
not.
That's sort of where my 90% comes from, at least, where I say just that goes aside, because you need to be a proper active manager. You have to be doing something that's not benchmarked at all, really. And that's where people like Nigel Thomas and Woodford come in. They do that.
Now we've talked about this a lot before, you and I, about what brings fees down in the active part of the sector. What is it that suddenly brings those costs down to make it look satisfactory from a money week investor's point of view?
Well, they have been coming down.
They have.
So let's start with the positive anyway. I just think I thought it was going to be a bit quicker, but it's not, and that's partly because of the legacy businesses that they've got. I mean, because if you're actually asking them to knock a huge percentage of profits off, and I just don't think that's realistic. You might like it, but it's not realistic. So you just gradually grind.
I mean, they're used to making super profits, right? So why would they want to stop doing that?
Exactly.
It takes a while.
And it takes a while, but the good news is they are moving down. And the interesting thing is the new entrants people. I mean, Woodford's an example. I mean, you could have actually charged a lot more, but we've got him at 60 basis points. So my view on what we do to try and beat managers up is say, well, if we can get him at 60, why can't you do it at 60? So we can't always get exactly that sort of price, but we're getting prices of between sort of 60, 65, and in fact, we've got a couple now coming in at under 60. Now
so just for readers who aren't in the industry, 60 means 60 basis points, which is 0.6%.
Yeah, exactly.
Yeah. Now, I have this theory. I want to know what you think. That the thing that will really change the fund management industry and really change the way fee structures work is pensions freedom, because we have all these people coming through who, in the past, I mean, people don't pay that much attention to the fees on their investments when they're saving, because they're not really looking at them that much. And in the old days, of course, they would reach retirement age and then they'd end up with a final salary pension, or more likely an annuity, right? So again, what it costs is by the by. Someone else is managing it. It doesn't affect them at all. They just get the money every month. They're done. But now you've got a wave of people coming through who are very computer literate, very savvy about costs in every other part of their life. You know, they spend hours on which looking for washing machines or whatever it is, and they have a chunk of money which they know has to last them for 30 years. So what are they going to look at? What is this costing me? And if they're doing what you always, I think you say people should do, which is use the equity market as nature's annuity.
Yes.
You know, have it pay you out a yield every year and live on that.
That's the safest way of doing it.
And if you're doing that, and you see that your costs are 1%, and your yield is 3.6%. 1% used to look like a tiny number. Now any idiot can see that's 25% of your returns going straight into someone else's pocket. And this seems to me to be the cohort that will start putting pressure on the fund management industry to say, hang on a tick here, we're all in this together, we've got 30 years to live, I can't live on 2.5%, I need 4, your share's too big. That seems to me to be something of a consumer turning point for the industry.
Yeah, but you're kind of assuming that all consumers look at it like washing machines, but they don't.
But that's my point. I think that they
will. Well, they may do in the future. I'm not saying that. You do in the press. You spend a lot of time on it, far too much time.
That's because fund managers get paid more than journalists, and it irritates us.
Oh well, I realise that, and particularly young journalists as well, who get absolutely paid next to nothing. And yeah, the fees could definitely come down. I think you might be right, but that's still a very gradual thing. And they could switch to more passive if they want to do that. They could get there now, but I'm not sure you could get a really good sort of natural yield type portfolio diversified just through passives, in my view.
No, I don't think you would
I
either.
think that's the problem. But you could reduce your fee down to some extent, and yes, I think there'll be more pressure.
Yeah. I mean, I think by the time I retire, which sadly is many years away, no one will be chucking 60 basis point at me. It'll be
But behind
30.
the scenes,
if Bailey Gifford can do it for 40, right?
Well,
Why
true.
can't everybody else?
Well, Bailey Gifford are a good example because we've got one of their funds coming in at that sort of price. In fact, actually, it might be below. I can't remember. So the pressure's coming from people like us as well, because we're saying, well, this group can do it at this, so why are you
Why
20?
can't you?
Why are you 31 basis points higher in some cases? And one or two groups have got huge expenses on top, so they come in. This is where it gets complicated. But you got a price at 75, but then there's this other thing called expenses, and some of the times these are over 30 basis points. So we're arguing with them. Well, in fact, we don't. We won't buy those at the present time. So we're putting a lot of internal pressure, if you want.
So you're looking at their ongoing charges ratio as well as the management fee.
Yeah,
and
we don't just look at the management fee. I want to know the expenses as well. And we're saying it's no good coming in at a super 50 basis points, and then I find that I've got another
backloading it
40 basis points of expenses.
Yeah.
That's no good to me at all. So I want an overall price. So when I give, like Neil's, it's 60. So I'm looking at 60 and saying, is that the price? And that's the price I want. I don't want another 20 on top of that. And the good news is they are moving down, and the groups know they're under pressure. The public quoted ones, it's just going to take a bit. It's just going to take a bit longer.
Yeah, they've got competing interests.
They've got competing interests, but it will get there.
Okay, one last question. My dream, my fund dream, is a one large fund, be it a unit trust or an investment trust, probably an investment trust, long-term capital, etc. That is a one-stop shop for readers who don't want to do too much of the reading that you think that they should do and don't want to focus very much. They want one great fund.
Well, don't you just buy
for
a big tracker?
all their money.
Don't you just buy a
they don't
worldwide
want to buy
tracker?
a tracker.
They want to buy a passive fund.
No, they want to buy an active fund run by a clever asset allocator who's going to do everything for them for 20 years.
Yeah, no one will do that. No one will get that right over that time period.
30?
Asset allocation is so difficult to do. It probably would be an investment trust. You'd probably buy one of the international trusts.
And it's kind of what personal assets does, right?
Yeah.
Except for they don't go into emerging markets and so on, so they're not.
So I don't think they're
global.
I don't kind of think they're wide enough. So you'd have to end up looking at something like Scottish Mortgage, one of those sorts of companies. But I mean, that's trade. I don't like those because they're traded at a premium. I don't like to pay.
I don't want to pay a premium.
I don't want to pay a premium for things.
So
either,
this is sort of like an old-fashioned, balanced, managed fund sort of thing.
Yeah.
One great one.
No,
there must be something you can
actually,
think of for our readers.
off the top of my head, in that sector, I have to come back to you. There isn't very much.
Okay.
It's really hard to find that sort of thing because they have their moments in the sun, as we call it, and then sort of crash and burn. Because the trouble with asset allocation is fund managers get themselves blinded, and then they think they're more powerful than the market and more right. So I can think of some few good fund managers who've blown up in the last few years.
Will you think about this for us? Will you think
I'd
about
be
this for us?
delighted.
And if you could think of one, and a viewer, if Mark comes up with a good answer, it'll flash up on a screen now.
Very good.
Mark, thank you very, very much.
Cheers. Thank you.
And finally, Mark's book, Effective Investing by Mark Dampier.
Thanks very much.
I'm anticipating that there's going to be a run on cash, that people are going to want real cash. By real cash, I mean dollars.
You mean actual notes?
Pieces of paper.
Actual notes.
Pieces of paper, because the whole economy works on credit. In a